following show is intended for mature audiences. Viewer discretion is advised. Get crunk. We are live. Episode, I want to say is 26 of Season 2 Coffee with the Johns. Friday, July the 9th. How's it going? Crazy week, rainy week.
Dude,
man,
BS.
but the weather all over the U.S., man.
I'm tired of it.
Freaking Seattle, Washington, all these places hitting like 115. I thought like July was supposed to be the nice months. They're just getting hammered with shitty weather.
Did you see that? Did I tell you about that video that I saw online about the guy that says he's like from Canada and just like that?
No.
Oh, it's hilarious. So it's a guy like sitting there like on his bed with like really like sad, depressed look, looking over the edge of like a bed or something like that. And he's like, "Hey Texas, it's Canada. Remember how we sent you one of our winter storms as a joke in February? We're really sorry about that." Like in a Canadian accent, it's like, "It was just a joke. Can you come get your summers back, please?" I just started dying because like he just has like this guy with the beard just sitting there like all depressed, just looks hot as hell because they don't have air conditioners.
Yeah.
At least here we do have heaters, but they're like they don't own air conditioners, so it's like just fans. It's 100 degrees, like 85 in their house.
Yeah.
I was talking to a friend of mine. He's like, "Yeah, it's like it was they had to put a window unit in the bedroom, just like the cool is like it was pretty because they don't have AC in their house." And he's like, "Yeah, I got to 85 degrees and it's like inside." And he's like, "It was just miserable. I'm not built for this stuff anymore." And I'm like, suckers.
Yeah, the heat sucks. That's why it's like, I always tell my wife, I was like, yep, we definitely overshot.
Oh my
Shit,
God,
I
you
should
and
not have come this far south. I did not know I hated the summer as much as I do. It's crazy. But that being said, I mean, right now it has not been a typical Texas summer. I mean, this whole week we've been in the 80s. That's definitely not
even
typical.
May, like it's like we never got hot in May except for like 1 or 2 days.
Yeah.
Like June kind of normalized a little bit,
Yeah,
but nothing
but
crazy.
even then, I think we had like a week or so maybe of like hot. But other than that, like, yeah.
See? Everything's
It's
shifting. So now
crazy.
this is where to be. Now you're like, I hated the summers. Now it's like, well,
Man,
here's
if
your new summer.
Texas can grow some trees and mountains, I'm all for staying here. I just don't see that happening.
You and your mountain.
That being said, we have a bunch of interesting articles and topics to cover today. We're actually going to be talking about, oil prices, how crazy they're going to be getting, especially with all the issues with OPEC and everything, what you can expect for gas and how that affects everything else. A lot of people just complain about gas prices every time they go fill up the car, but it's like it affects a lot more than just your gas tank. So we're going to be covering that. There's some very interesting real estate news for San Antonio, Texas, opportunities coming everybody's way that if you jump on it, it's some great opportunities. We're going to be talking a little bit about this massive $70 million ransom hackers did over the July 4th weekend. So a lot of fun stuff, a lot of good articles. One of the things I actually wanted to start with, especially as everybody's prepping for, summer traveling and everything, getting ready to go to the beaches, is how shitty Texas beaches are. And I don't mean that just in like, oh, they're shitty. No, like literally shitty. So, heading to the beach for a getaway, be careful which beach you go to in Texas because swimming in poop is nobody's idea of a good time. Yes, it's gross, and yes, it's true. Several Texas beaches have been deemed potentially unsafe along the Gulf Coast because of fecal matter, sewage, poop, human dung, whatever you want to call it. So Newsweek reports that according to an Environment America report, beaches along the Texas Gulf Coast were worse than the national average. The report didn't mention what the national average was, but did say that 82% of the 220 Texas beaches, which is 180 beaches, they apparently did the crazy math there, came back as potentially unsafe on at least one day in 2020. Two of the worst spots were Cole Parks Beach in Corpus Christi and Sylvan Beach in Laporte. Or Laporte? I don't know. Never been. With 60% of the days, it was tested deemed unsafe with fecal matter and contamination. So, when are you going to the beach?
I bet this is written by somebody.
That's just disgusting.
Or Florida.
I mean,
somebody else.
I'm not a beach person by any means. I could care less about beaches, especially I've been to the Texas beaches. Nothing impressive there. But my God, like literally shit in the water is just one of those things that's like.
You not know fish swim?
Yeah, but they're saying human shit, like not animal, not regular. That would be the same in every beach.
Every water. Like
yeah,
we're all living beings.
Well, apparently they
water,
tested all the beaches, and Texas has by far the most. So it's obviously not every water.
Okay,
but yeah, pretty gross. So just letting you guys know, that good news for you guys that are thinking about going to the beach this summer. Enjoy your Texas beach. Just close your mouth. What topic?
Let's just close your mouth.
What topic would you like to
I don't know. I'm supposed to follow up with that. I mean, God, end with that.
We're in the summertime.
End with that. Don't start. No, it's like, well, there's the beginning of the show talking about poop.
People need to plan.
Right? No, I don't even know.
Okay,
well, throw me off. You grab one.
So let's start with San Antonio, right? So San Antonio it's finally kicking off $130 million plus development, envisioned as Pearl on the east side. Everything is a Pearl. Every time
Pearl
they do everything.
This
is the mini Pearl. My God, just do something different. But anyway, the 192 unit apartment complex marks just the first phase of $130 million mixed-use development intended to spur commercial and residential activity on the east side. So Miami-based developers building villas at Echo East, a $43 million apartment project on 7 acres along Sprigsdale Boulevard between East Commerce and Martin Luther King Drive. So this is just south of the AT&T Center and all of that.
That's a long way away from downtown to be the Pearl of the East Side.
Yeah, it's not the Pearl because of its proximity to downtown. I guess it's just because, I mean, and it makes sense. You think about it location-wise and everything. But it goes on to say the George Gavin Youth Center with affiliate Eastside Pinnacle Group plans for the apartments to be the first phase of the large 20-acre mixed-use development with 500 residential units total. Now, the residential property, a partnership with the San Antonio Housing Trust, will have 1, 2, and 3 bedroom units ranging from $834 to $1,156 per month in rent, scheduled for completion by 2020. So, my question to you, right?
Okay. So the rents are between $834 and $1,156.
Yes.
That's it.
Yes. So that was my thing, right? So we're looking at this as real estate investors, as everything that we bring up on this show. How does this affect you as a real estate investor? What opportunities do you have? What can you seize? But when you're looking at this massive development being done in that area, which is, I believe it is needed because you're so close to AT&T Center, the Coliseum, all these things. That's like, yeah, we all drive by there every time you go to a Spurs game, and it's pretty ghetto to say the least, right? So it's like to revitalize that whole area makes sense. But then you're looking at $834 to $1,156, the max on rents.
That's not by any means like high end, even like middle to me. It's like they're building for the area.
Yeah.
It's like it's more of a dilapidated, rundown kind of area. So I mean, it's more of affordable housing. When I hear that, it's like, especially when they're building with the San Antonio Housing Trust, because that's what it's designed for. It is like it's more for affordable housing, and it's subsidized, and it's like, and now if those were in like the 1600s, like okay, now you're actually getting it up into something that, like, I just don't know what you could have at the affordable housing rate to make it Pearl-like. Like the Pearl's awesome for the fact that it's like they have a diverse entertainment district kind of thing. If they got bars, they got restaurants, they got all kinds of things. Where like this, when I hear rents that low, I mean that's well below the average rent in San Antonio, especially for like single family houses. I don't know what it's for apartments, but yeah. Or just kind of made that face when he said 1156. Like,
oh, I agree. Well, because I looked at it, I was like, all right, that whole area. I mean, talk about opportunities. Like, damn near every single house there is ran down. It's, needs work. The whole area just very neglected, very distressed. That's like, all right, cool. This is technically, usually when we see this kind of developments going on, that revitalizes the area. So for real estate investors looking at this, okay, this area is going to have low rents and everything, but don't you think because where it's located, you're pretty much between Denver Heights and this area, that's getting all this. Do you think that kind of bleed over is going to help investors? It's going to help maybe appreciate a lot of the homes in those areas, appreciate some of the rents? Or do you think it's, not very a good investment opportunity?
I mean, any of it's if you buy it low enough, because a lot of those houses are so dilapidated, you can get pretty low. But like, I mean, I'm really kind of torn on it, honestly, because it's like, yes, the revitalization is nice because you see the development going in there and things are going to spur off of that. But it's also like, is it going to cater to the clientele of the area, the density of the area? Right. So it's like, you're not going to get, what's that high-end like Italian restaurant, Paisanos. It's like Paisanos isn't going to open up in a strip mall. Ruth Chris is not going to build right next to that. It's like you're not going to get a lot of like higher end things that cater to the higher end clientele, like the housing right there. You get to Dignity, Denver Heights. It's like, well, you have downtown right there, so you have some higher end things that those people that can afford that like to go to. But now over here, it's like it's going to spur economic development, but of the lower tier of
correct.
I don't know what the word I'm looking for, but it's not going to be your high end stuff for like $400,000, $500,000, $600,000 houses.
Yeah, you're so trying to be politically correct. I gotcha. But looking at that, it's pretty much you think about it to your point, right? What restaurants are going to open up there? What kind of food places? What kind of shops and everything? If you're keeping pretty much you're targeting very affordable and all that, you're not going to have, like you're saying, your high-end restaurants, your shopping places and all that. It's going to stay kind of like your fast food. It's going to stay, because as we keep seeing inflation, we're going to touch on this topic a little bit later on, the biggest struggle restaurants and everybody's facing right now. But
that's exactly
as we see inflation, we see all these things creeping up and causing big problems for restaurants. Like, yeah, I mean, it's interesting. I'm very curious to see, kind of dig into it a little bit more as to see what economic impact they're seeing. And also, is this rent range more of a kind of like their sell pitch, to get that kind of funding and the backing from the city? And then when they actually finish, it's like, well, look at what happened with the market. We're going to have to do rents higher.
Look, the city, look how, that was what we could have done but you didn't let us build this quick enough. So now values are higher. Everything's higher. It's like, we got to rent for a higher point.
Thanks for all the tax advantages. And here we go.
Yeah, but now that they're targeting it to begin with. Because I mean, I know like there's other apartment complexes that build it. It's like their lowest rent starts at like $1,200.
Yeah.
In that, like, not that area, but like towards the downtown area or in the Pearl, like in the Pearl, like, you can find it like, God, I think I was looking at just to see, like, they have one of the towers there for rent. It was like $1,900 or $1,800 for like a 600 square foot studio.
Yeah.
In one of the buildings in the Pearl. Like, that's the kind of thing that like makes the Pearl.
And there's a wait list.
Yeah. And it's like, so it's
something
much different.
To add to this article is there's another article that this is something that I look at, what does this mean? Kind of read between the lines. What does this mean, especially for that area? Is that the San Antonio Spurs are losing AT&T pretty much. So you have the AT&T Center, right? It's the name. AT&T is the one that's paying the bills, all that for that area. They're not renewing their contract. So the San Antonio Spurs and the AT&T are ending their professional relationship after the telecommunication giant chose not to renew its present deal as the sponsor of the Alamo City venue currently bearing its name. So on July 2nd, they pretty much said we are not renewing, which it expires at fall of 2022. but the company also recently sold 7.23% minority interest in the Spurs. So this is nothing ominous. Fucking word. This is nothing ominous. The source told the front offices that it was just time. AT&T's priorities have changed. And it continues saying AT&T has reportedly been looking for a cost-cutting measure in light of its deal to merge its Warner Media unit with Discovery, according to the San Antonio Express. Additionally, AT&T has a major commitment to another beloved Texas team, the Dallas Cowboys. The company pays close to $20 million each year for naming rights on the football team stadium in Arlington. So based on the Spurs' recent value of $1.8 billion, AT&T made an estimated $125 million from its original investment in the team, according to Front Office Sports. So my question, my thought process here is like, you made a good amount of money. We're seeing all this growth in San Antonio, all this growth that we're seeing that's tremendous coming to the city, right? People moving in, money coming in, all of these things. Why now cut and run, right? Like, why? What is AT&T looking at? Because, okay, I understand. You have an opportunity in Dallas. I'm sure you can afford both.
Well, it's not that they have an opportunity in Dallas. Like, they already have Dallas. Like, it costs them tons of money to put their name on those buildings. Yeah. And to where it's like I said, $20 million just to put it on the Dallas stadium. Where it's like, I told you why. It's like, hey, we're looking for cost-cutting measures, and it really doesn't.
But with the return that you're getting from the Spurs that you've been getting, they're paying $2 million a year for AT&T Center here in San Antonio, $2 million a year, and they've generated $128 million profit since they've got it. I think they've been there for 20 years.
That's just their stake in the Spurs.
Yeah.
From what they paid for the Spurs, when they sold the Spurs, they got that return on just their interest in the Spurs, a 7% interest.
No, I understand, but what I'm saying is that the team is gaining more value. You know, with all the people moving here, with everything, you have an NBA team in the city. It's pretty much the biggest sport in the city available.
Sport, but
it's the biggest professional sport in the city. That's like, with all the people moving and everything, like, I could definitely see ticket sales going up tremendously. So it's like, why would you know what I mean? I don't know. I was just curious, like,
well, they don't get revenue from ticket sales.
No, but it brings up values of the team, and brings up value of their investment, brings up all the values.
Yeah. I mean, I guess it's just like, they're playing big ball to where it's like, look, they got other things, other places to where it's like they see better opportunity putting their name on a freaking stadium.
Yeah.
Or it's just like, nah. So I'd always wonder, like, I'd like to see, like, what is your return from like throwing your name on one of those massive stadiums? And they're like, it's like, you just get a big billboard with like AT&T written across it. Like, how do you calculate your return on those deals?
How do you think? Okay, so do you think that helps? So they have the AT&T Center, right? You think, I guess subliminally to people, they see AT&T, then they're gonna go choose which network, and it's like, well, it seems like AT&T is a safer bet to go with.
I mean, that's what you're versus when you're that big. It's just like,
do you think
it's one of those, like, I always thought about, like, names on billboards or things like that. It's like, it's ridiculously expensive to do that, and it's not like something like to where we, like, a small business does, like, they can barely scrimp by to put their name on a billboard.
Yeah,
it's just like, no, that's not where you do it. You're not going to get the return. You're going to go broke trying to maintain just that market thing, and you're not going to get the return from it. It's like a thing where it's like, you spend money on these things when you have nothing else to spend money on.
Yeah.
It's like, well, we got these big marketing budgets and things like that, and we've really kind of tapped out our returns on social media, TV, and things like that. So, like, well, we just do these extra things now to get more, try to generate a little more from it. So I've always wondered about when it comes to, like, those big names, those big brands, like big scale corporate marketing stuff, not stuff that, like, small businesses do. Like, how do your budgets work? Like, what do you guys see? Even like some of, like, these massive, like, ads you see that, like, a Super Bowl, it's like millions and millions and millions of dollars. Like, they wouldn't spend that unless they're thinking it's getting a return. But it's like, how do they track their return of spending $40 million on a 30-second Super Bowl ad?
Well, you obviously see the spike, right? Like, I mean, a Super Bowl ad, we both listened to the Gary Vaynerchuk, and he's big in the marketing space. He's big in all that area, and he talks about like Super Bowl ads are the most undervalued assets because they're still so cheap relative to how many eyeballs you get for that message, right? So for that 30-second ad, yeah, you're probably spending $5 million, but you're getting millions of eyeballs on that, and along not just during the Super Bowl, but like the Super Bowl commercials are by far the biggest thing. So people are rewatching them on YouTube.
Yeah.
There are people that miss them. They're playing them on the news later.
Stuck in their head for years later, like Puppy Monkey Baby. Like, I still remember that one from, like, God, what was that?
Oh,
like
Mountain Dew, wasn't it?
Yeah, Mountain Dew or somebody. I don't know. Like
that was just creepy. It was like, what the hell are we watching?
It worked. It was like Puppy Monkey Baby.
But
Puppy Monkey. You're like, oh my God. I think the next year they followed up with it too, with another one. So
yeah, but I was reading a comment here that Brian made a good point, and he says probably 20 to 30% has to be in the target range, referring to the housing that they're developing on the east side. So we've seen that before where they're saying, all right, look, yes, you're going to build affordable housing, and it needs to be a certain percentage of the total development that needs to go to affordable housing. You know what I mean? So it's something that's like it needs to be more of what percentage goes directly to that, to affordable housing, to all of those things. So that, I think, yeah, that's an excellent point, Brian. I think that's it's going to be something to look into a little bit more and kind of see what are all the terms, because if they can't bring in high-end lifestyles, high-end, apartments and housing and all that, it's going to be hard to bring in high-end or any kind of retail, because as retail and all these things go up, and I mean, we can get into that, the restaurant topic, or do you want to stay in the real estate side?
We can stay in the, well, let's keep the real, because it ties right into it. Go ahead and do the restaurant one, and then we'll jump back to real estate from it. Because it is important to where, like, what is that area going to do? What is it going to spur? What kind of development is it going to be? Because I think restaurants, like, in these next couple of years, like, restaurants, the way we used to think of restaurants, is going to drastically change to what we were used to seeing as far as, like, pricing and stuff go for. I think that's going to have a big factor on that area. If, like, wages in restaurants go so high, it's like, you got to think of the demographic that's going to move in to where, like, Brian's point, like, if it is only a percentage of that, great. But the way they wrote that article, when I've seen these articles come out, they usually say this many percentage of it is in this price range, and then the rest is, they leave it open so they can do whatever they want. But they're saying, no, like, this one, like, the whole target is that price range. Yeah. So that is something to me. It's like, so what exactly are they gonna do with that area? So, I mean, regardless, I think it's going to be good for it, because I know in that area, it's like, yeah, it's probably just some vacant land with some really rundown, like, industrial, commercial complex thing that's just
for sure
falling down. So, it's good for it, but how far is it going to go?
We will see more complaints and everything as far as gentrification and all of that, because, of course, you're going to be redeveloping those areas. Even at the bare minimum, it's still going to raise home values. Even those home values that have not moved in decades, they're going to start going up. I mean, because it's just like, you can't have brand new development, all that coming in and it not go anywhere. So, very interesting to see what that looks like. But touching on the restaurant topic, so you have Kraft Heinz CEO said that his company is very concerned about the drastic rise in inflation and looking at the possibility of increasing prices for consumers. You can almost guarantee that every restaurant owner in the country is facing the same difficult choices. Think about it. If inflation continues to increase, the cost of raw ingredients and supplies will continue to increase right along with it. It's only a matter of time before restaurants further increase their prices to consumers. The fact that labor shortage is also forcing many businesses to raise wages to court the dwindling supply of potential employees all but guarantees a call-out choice, raise prices at the counters, or potentially go out of business. But inflation, quote, printing money, doesn't just raise the cost of food, it devalues the dollar, a hidden tax on everyone as it raises the cost of everything. As the families are faced with increasing costs of utility bills, groceries, gas, and household essentials, they will be increasingly less likely to spend on extras. All of this is particularly tough for the pizza delivery business model. Imagine you own a pizzeria. Not only are the costs of your raw ingredients rising from flour and salt to tomatoes and mozzarella, but gas is more expensive too, as are employees. On top of that, inflation starts to wallop your customers. Yeah, wallop your customers, and those families that order at least once a week start ordering every other week and then just once a month. So this article is actually a very extensive article, and you can definitely see where this guy goes because he even got into politics in the article. It was an interesting.
He went deep, huh?
Yeah, and I honestly don't disagree with a lot of the things he said because it's all based on what could happen in certain situations. So I do recommend you guys go check out this article, and all the links, everything are going to be provided below. Once the episode is over, we're going to add all the links and everything so you can check that out. But that being said, I mean, you're looking at everything he is saying, and yeah, I mean, it's getting very tough for even, like he says, even as simple as a pizzeria. You're delivering pizza, but your material, your ingredients, all your things are going up. Now, you have gas prices going up, which we're going to touch on. You have employee costs going up. You have all these things going up. How are you not going to increase the price of the pizzas, right? And then you increase the price of the pizzas, and you have people that are getting hit by what he calls a hidden tax, which inflation has always been called a hidden tax.
Yeah.
And I think it's very accurately put. That's like, well, now everything has gone up for them, where it's like, yeah, we're probably just going to get, we're not going to get delivery. We'll get DiGiorno.
Get the Giornos.
They're going to go to your supermarket, get that freezer pizza, and that's going to be the next best thing. So,
Yeah.
I mean, what do you think?
Well, I mean, to tie it back to this topic, or I mean, that side of the part, we were talking about earlier, is like, so what kind of restaurants are going to appear there? It's like, it's not going to be your go out to eats or your pizza delivery. It's like, it's going to be continue your McDonald's or your Taco Bell's. It's going to be your fast food, to where it's like the clientele of that area can afford, or over on that side. So, I mean, it is going to spur development, but it's like, what kind of development, how high is it going to go? So I think it's going to be a great rental market, because like Denver Heights, Dignities, like those aren't rental markets anymore. The values of the homes are way too high. The rents aren't there. It's useless. Well, not useless, but it's like you're not going to get cash flow from it in traditional rental space. But I think this area is going to transition into a good kind of blue collar kind of working area, and which is needed downtown. You can't push everyone out from downtown, because like you still need that style of worker in the downtown area. So the further out they go, the more price increase. We've covered that in depth in previous topics. But I think on that side, it's good to see that development go on that side of town, to see that kind of development, where you can have that kind of workforce in that area. So, I mean, it is something as far as like a rental play, where like if you can buy things, it's going to get an initial boost for rents, because now people do want to live in houses versus apartment complexes.
Mm-hmm.
So it is going to redevelop. That hard? Jeez. It is going to develop that area to where, like, if your more cash flow style rental plays that we ourselves target, I think is going to kind of hit into that area.
So I wanted to see, there's some comments in here. Marlon Brimmer, he puts on that this is temporary inflation. We just got out of a pandemic, and increasing the price of pizza by 50 cents. Life isn't over. Pay your workers a living wage. So we actually did cover this on a previous episode about whether this inflation is transitionary, how, the Fed is calling it and other people are calling it, versus something that's a little bit more consistent, something that's going to linger. And we covered a lot of data points and everything on why it seems like it's not so transitionary. It's not so temporary, because there's a lot of big factors playing in here that, yes, the economy is kind of getting back to working and everything, but it's not the same economy as before. So even though like we saw lumber prices shoot through the moon, right? Yeah, lumber prices are going to come back down, but they're not going to come down to the last lows, right? Or to the last normals. Like they're probably going to be somewhere in the middle from the crazy high to the crazy low.
And it's one of those things like come back to the real estate side of things. It's like one of the big factors of the core inflation numbers is the cost of housing.
Yeah.
So yes, energy prices, food prices, all that stuff is all over the place, and that should settle down once you kind of work those kinks out and things like that. Like the real estate prices, those are much, much, much different. So where commercial real estate data company Yardi Matrix has updated its multifamily rent forecast for 2021, with several markets receiving an upward revision in expected rental rate growth. The vaccine rollout was going so much faster than we expected or were expecting, said Andrew Simmons, senior research analyst at Yardi Matrix. In March or April, a lot of these markets responded largely to that, starting seeing very big increases. Some of the biggest increases could be felt in secondary markets not captured in reports. Boise, Idaho, Reno, Nevada, and Portland, Maine are some of the metros areas seeing fast population growth coupled with constrained supply. Boise, for example, saw 11.6% rental rate growth in the first quarter of 2021 compared to the same time last year. Yardi Matrix predicts for Boise in Q3 and Q4 are 10.7 and 9.6. Like 10% year-over-year rent increases. Reno posted a 5.3 year-over-year rent increase in Q1, and 7.9% growth is projected in Q3 and Q4. A shift to more remote work is helping propel growth in smaller cities, Simmons said. What should be transitionary inflation in certain sectors due to logistics and pandemic-related supply chain issues is now threatening to be much broader and could have a real impact on purchasing power, which would limit the ability to push further rent increases. Mm-hmm. So to where like his point where, yes, a lot of this stuff is transitionary, but the thing is, like right now, it's like you look at like construction work, like there's a massive demand for housing and there isn't housing. And you look at the regulatory burden in building properties, how long it takes from I'm buying that property to where somebody can move in and can actually live it is so long that it takes so long to catch back up for this demand in housing across the entire nation. Where supply and demand, it's going to push prices up. And when that rent price is so much of the core inflation numbers, that is something that can really bog down into, quote unquote, the inflation, really start taking real bites out of people's bottom pockets. And then it comes back to the living wage aspect of it. It's like the cost of housing is so high to where they have to increase wages for people to be able to afford that area, which trickles down into your food costs and price.
And that's something that, you know, we've covered previously, and what we try to show with this, it's not, you know, to Marlon's point, you know, it's not the end of the world, of course, and it's not, you know, something for you to freak out about, like everything, life's ending. It's not to that extreme. That being said, like, everything is tied to everything else, right? Just because one area is getting hit doesn't mean that the other ones are going to be affected. So as you see all of these areas get affected in different ways, it's going to trickle and it's going to hit other areas because, you know, high rents causes people like the owner of Heinz, like he was saying, you know, people's cost of living is going up. Rents are not going to come back down to pre-pandemic level. Home prices are not going to come back down to pre-pandemic level. So these are real expenses that people are having, you know, and they're going to keep having. And wages, when you start increasing wages to, let's say, like he says, you know, pay people a living wage. Well, when you increase wages from, let's say, a pizzeria that usually pays what, $9 an hour, if that, right, to now $15, $16, like it's not going to be a 50-cent increase on a pizza. It's going to be substantially more. It's going to be probably a couple dollars, if not more, on a pizza. And then you add that to the cost of everything. And ordering a pizza, ordering out is just an extra. It's not a necessity. So those are things that people start cutting out. Another article that kind of piggybacked on all that to kind of just show how everything connects is restaurants pushing digital orders in the labor shortage could mean diners asking for more food because they don't feel judged by the servers. So this was a funny article. So restaurants are rolling out ways for customers to order digitally, which could lead to diners placing bigger orders because they can hide their embarrassment from servers, one expert says. When customers order digitally rather than through a server, they're more likely to choose the food they really want, said Deepai, the global director of product and marketing at a advertising agency. And he says that this is because they don't have to worry about the servers judging them. People order more, and the tables turn over faster because they can get their orders and they can get their bills much sooner. During the pandemic, restaurants have been pushing dine-in customers to order using apps or QR codes printed on the menus or glued on the table. Starbucks is encouraging customers to order in advance on their phones for drinks to go, while Taco Bell is pushing digital kiosks and is even rolling out a new restaurant format based on mobile ordering. As mobile and drive-through sales soared during the pandemic, Starbucks customers placed fewer orders, but they were more expensive, said an insider, apparently. This is down to a mix of customers placing bigger orders and getting more modifications. Even before the pandemic, rising wages in the restaurant industry meant that chains like McDonald's had been turning to kiosk ordering to keep down the staff costs. A lawyer specializing in retail at Robinson Solomon and whatever that company is, and restaurants are currently scrambling to find workers amid a huge labor shortage across the U.S., which could make digital ways of ordering, like through apps, kiosks, and QR codes, even more attractive. So looking at this, right, this is what we talk about. What restaurants need to do in order to keep their costs down is they're going to need to create more automation. They're going to need to create ways that they can systemize and lower their employee count, because if not, they have to raise food costs. And if they have to raise food costs, it makes it even harder for people to consume, which makes it harder for the restaurant industry. So it's something that everything ties to itself. Everything is tied together. If restaurants are right now, especially these fast food chains that we talked about it before, like Pizza Hut, Domino's, McDonald's, they pretty much have like kind of like a conveyor belt system set up
I
on
just
how
remember,
the
like,
food
as a
is
kid
spits
going to
out.
McDonald's and how many people were working in the back. The people were just like crawling over each other back there. I mean,
Yeah.
just making burgers, flipping, stuff, going crazy. To where now it's like maybe half the people, if less, in some of those restaurants that are there working. So yeah, I mean,
and you look at it, not just in restaurants, but how many times have we gone to Home Depot or even if you go to like Walmart and stuff, they'll encourage you to use their apps to find stuff on the shelves, to use their apps. Like Sam's Club, you can even use the app to scan and go. Like you can go shopping, scanning all your items.
Really?
And then you can just walk out. You don't have to go through the register.
Home Depot the other day, or I mean, you look at HEB even, or restaurants or grocery stores, where like the kiosks there were used to have like two people to do their own checkout. So you had an employee scanning and a person bagging. To where now it's like, well, you have a lot of people that are only getting like 10, 12 items because of like how fast they come in and out and stuff like that in these grocery stores, where they can have one employee watch that one section of 4 kiosks. So like when I go to, especially like a Home Depot, it's like usually people aren't buying hundreds of materials like they do at a grocery store. Yeah. It's like they're going in, they're buying a few things, and they're big items. You would usually even putting those in sacks to where like one person can look after like 4 to 8 kiosks in that area. So instead of having 8 employees, you're down to 1. Or even like HEB, same thing, where you walk in some of these big grocery stores, it's one employee that's looking over like 10 self-checkout kiosks in like one section. Or it's like, and I have an HEB not even like 3 minutes from my house. Or it's like I drive to it, like if I just realize like, hey, I just need to go get butter or something like that, it's like I just walk in, grab that one item and out and go, because it's so convenient and so close. And like I enjoy the self-service kiosk because I don't have to wait in line for like somebody's got 20 items in front of me or 50 items, and I just have one item that I need to scan, but I got to wait 30 minutes just to make through the checkout line. Or now it's like I just go through this express lane and I'm out.
And they want to pay with a check. That happened to me the other day. I was like, "Oh my god, lady, come on!" But that being said, like Marlon continues. He says, "Equity firms are buying all of the single-family homes. Regular people can't compete with cash buyers. We need more regulation on these huge firms snatching up properties. We're gonna become a renter nation." So yes, I agree with you that equity firms are snatching up a lot of the residential real estate and everything in the market, and it is insane the amount that they're buying. That being said, I'm always a little wary with when it comes down to regulation, because regulation tends to overregulate, right? Where what would help, I think, more is if they were to, let's say, deregulate a lot of what we talked about before, a lot of the building process, so then we can drop more property, more inventory on the market.
Yeah.
And then by dropping more inventory, more properties
Well,
on the market, it's going to make it more affordable for people to buy.
Let's look at why people are why equity firms are buying these properties.
Yeah.
It's because home values are increasing at such a rapid rate. Rental prices are increasing at such a rapid rate. So they see great returns in real estate. And like, why? It's like because there's such a huge demand for it by the general public that it's like they're not bidding each other's prices up. It's like, no, the general public is driving these equity firms into this market to buy it because prices are increasing so much because we as builders can't supply the market. It's like, I bought a lot that already had a slab. It should really just be able to buy it and within 3 months have that thing up for sale, done, over with, closed, on the way.
Yeah.
Like, but it took me 4 months just to get through the permitting process. So now it's just like, I can't supply the market. And it's like, and we're not one-off stories either.
No.
So we're like, you talk big commercial developments. I mean, the process that these people can get roped into just takes forever. So whereas like, I mean, and I'd be curious to see the numbers as far as like equity firms, like how much they actually are buying. Cause like I hear about it in news, but I don't hear about it in the actual real estate community. I don't hear about, I mean, I did hear like a lot of private equity firms buying these things back in 10, 11, 12, 13, 14, but they really kind of died off around 15, 16 because like the returns weren't there anymore.
Yeah.
So I'd be curious to see like what the actual true numbers are, around that.
Yeah, and we really do appreciate your comments, Marlon. Keep them coming. That's the whole point of this is, to create more of a discourse and conversation and back and forth, so we can all be more educated. We can all protect ourselves and our families and help the community as much as we can. But with that being said, you did have an article that I was interested in that it says mortgage applications are sinking. So what happened with that one?
Well, I got several that kind of tie into each other. So let's start with going back. When did I do this? It was a month ago. Of home buyers are growing weary of the housing market. This is a little short article, but it kind of ties into it. The latest Fannie Mae Home Purchase Sentiment Index shows that just 35% of consumers believe now is a good time to buy a home, down from 47% in April. And those who believe it is a bad time to be a home buyer increased to 56% from 48%. Consumers appear to be acutely aware of higher home prices and the low supply of homes, the two reasons cited most frequently for the particular sentiment, said Doug Duncan, Senior Vice President of Chief Economist at Fannie Mae. So that was a month ago. Now you move over to the mortgage applications. Mortgage demand, and this is from, I think, the same publication. Mortgage demand fell for the second week in a row as low inventory and high home prices continue to weigh on the housing market. Mortgage applications decreased 1.8% last week, according to the Mortgage Bankers Association seasonally adjusted index, falling to the lowest level since the beginning of 2020. So that's what's crazy. Like, mortgage applications are even lower now than pre-pandemic, even though we were still like in a hot market then. Mortgage applications to refinance a home dropped 2% for the week and were 8% lower than a year ago. Refinance applications have trended lower than 2020 levels for the past 4 months. Home purchase applications dropped 1% for the week and came in 14% lower than a year ago. Mm-hmm. So I think now we're getting into the time where a lot of these articles compared to 1 year ago when this whole boom started, like that's when it really started. July was really when things really started to change when you look at the data of when home prices really started to increase. Yeah. So now it's going to be interesting to see, like, are we slowing down or are we speeding up and things? So a lot of this information is coming in. It's like, hey, from when this whole thing started, we're not still increasing. Like, we're actually slowing down. So you got the spike. We're on the backside of the spike, even though year over year things are still increasing. So it's going to be interesting to see how the year over year changes, because I think is it going to be a one-time blip that, hey, we're seeing double-digit year-over-year price increases now that we're starting to get into when this whole thing started, or is it going to continue to rise? So that's stuff with the market reports that I'm interesting to see, and I mentioned that in the last one we dropped, was it last week? Yeah, right before the 4th of July.
Yeah.
We dropped the market report where I mentioned it in there. Like, I'm curious to see what this data is going to look like once we get into the boom times and out of the end of the pandemic. Because of course, you look at April over April, we're going to have a huge increases or April and May, because that's when prices were depressed the most, or when home buying depressed the most. So mortgage applications are falling. So that's something to continue to watch to see, does it pick up and what really happens? Because I know there's some stuff in the financial news this week but the 10-year treasury is starting to slide a little bit, which ties closely to, not closely, but loosely to mortgage applications and things like that, or mortgage and interest rates. So,
yeah. And
what are your thoughts on it?
I mean, yeah, all of these things are huge plays on what's going on in the market, why people are starting to a lot of buyers are starting into, Marlon's point, a lot of people are starting to cool off. A lot of people can't afford, can't compete, and even with the whole refinance and everything, it might show that it's just I'm curious as to, is it that people just don't qualify, because the people that are either continue to be unemployed or underemployed. And this is something that I've talked way before the pandemic about, is that we used to brag about the low unemployment numbers. But to me, I was like, we still have a large population of the employed that are severely underemployed, that they're not making living wages. They're having to have one or two jobs, or a lot of even the younger people that were still living with their parents because they couldn't make a wage to sustain themselves. So that was pre-pandemic. Now we're starting to see wages rise. We're starting to see all these things rise, but it's going to take some time for all this, because as wages are rising, they're not rising as quickly as home prices are. They're not rising to that level. So it's like, I think as we see all the people that kind of like jumped on the market, that had that influx of money, that were making those moves, everything, I think we've seen a lot of that come through. And I think we're starting to see that kind of like cool off a little bit. And the people that are kind of left are still struggling because they're not really able to afford all of these things. And then, one thing that Marlon finished off with is that deregulation equals the condo that collapsed in Florida. So that is not what I mean by deregulation. What I mean is, and I linked below an article that we talked about, an episode that we did on the affordability issue, and especially in San Antonio. And it's not deregulating the building process. I've never encouraged that. I've never said that, you should. I'm not saying deregulate the building process. What we're talking about is the bureaucracy prior to the building process. You know what I mean? Like we talked about the permitting, the issue that we had to wait 6 weeks, even though they had given us the answer like day one, but they're like, oh, you got to wait 6 weeks for the board to convene. And it's like, but you guys are the board and you're telling me that we're good to go. Why do I still got to wait 6 weeks? Yeah. And then the 6 weeks, the cost, the delays, all these things, like they hurt the builders. It's something that's tremendously hurting builders and everything. And we saw it when we built the house in Seguin, that one house, just the permits were like 10 grand.
Yeah.
You know what I mean? Where it's like, this is insane. We're not talking about the actual building of it. It's the
streamline of it. Because like once like you're past once I'm through the permitting process, like you can really put up a house. Like it's amazing like how fast buildings get built. When you're like, you drive away and you come back 2 months later, like, my God, that building got there fast. Like, holy crap.
Yeah.
It's like, but it's the pre-development, I guess, is the terms behind it. To where it's like, this department doesn't talk to that department, doesn't talk to that department, doesn't talk to this department. Mm-hmm. Well, this department makes you do something, but then that other department over there says, well, now that you did that, you can't do this. Yeah. And then it's just like, oh my God, like, is there just like it's a very vague way that it goes through the regulatory process to get the okay to build. Yeah. So where it's like, we took a house, a lot, like cement was already there. The house is already built. This whole subdivision had already gone through the regulatory process of being built. And it's like, I'm trying to build the exact same house right on top of what was there. Yeah. And because of that, it's like, oh, because of the zoning codes changed in the 80s, now this is non-conforming to it. And it's just like, it was built here this way. Like the city of San Antonio approved this building in 1981. And it's like, here we are 40 years later, I'm trying to put the same thing there. Like, what is wrong? And then with that, that's where it just like you couldn't get answers, you couldn't get anything, and it's like that's what became so frustrating. So that's the portion we talk about deregulating. It's not going skimpy on the engineering, because like what happened with the condo collapse is like it was an issue with a lot of it came around not regulation, but it was the inefficiency of regulation. They were trying to make these repairs. There was multiple reports coming out of like why this thing costs. Like years ago, like you need to do modifications to this building. It needs to be done. But then like because of the condo associations, people didn't want to raise their money. You had too many people not making the decisions.
Yeah.
And because of the regulatory laws in place, it didn't get repaired and the building collapsed. So those are the things we're talking about, like deregulating is that aspect of it, of just like getting things done that need to be done in an efficient and speedy manner.
Yeah.
That's what we're referring to.
Well, and
like
that's exactly, I mean, I think that's an excellent point, because that's exactly what happens. And I interviewed Seth Teal, and that interview is also on our channel. You guys can check it out. But Seth Teal, he's owns a realty here. He's a broker. He's a developer. He's an investor here in San Antonio, and he joined the boards because of all these issues. And his hopes was that he can join the board and help this situation, help make this much easier process and everything. One thing that he realized, and he even said it, he's like, they know what the problems are. They just don't care, and nor do they want to fix it, because the nickel and diming that they're doing is like they're making a lot of money off of that. So they're like, they rather do that than make the process smoother and better. But it's like you and I have said countless times, like, look, whatever the nickel and diming you want to do, we'll pay you all that up front. You know, just don't kill the time, because for builders and developers, time hurts.
Yeah.
You know what I mean? If you delay our project, it costs us more money. It hurts us with our labor, because we have people lined up and now we got to delay. We got to postpone. They go find other jobs. Yeah. And then for us to get them back to our project is going to take some time. And then we're sitting on this project. And the more we sit, the more we spend, the higher the cost of that project is going to go.
Yeah.
And then the only people that are getting benefits are these massive developments, right? That they're getting these government helps and these tax breaks and all these things for the stuff they're doing. But they're not able. We go back to what he was saying about, you know, it's all these big companies are buying up all the real estate. Well, it's like, well, that's who the city helps.
Yeah, they don't help the connections. Like, I don't know the council people of San Antonio that approve these things. Big developers do, though.
Yeah, for
they
sure.
contribute to political campaigns. Like, hey, remember I contributed to a political campaign? This is that favor I called in for you. That's why you have that money. So
yeah,
that is something that is interesting.
Yeah, and but one thing, go ahead.
I mean, just on this topic, I was going to do one more of real estate topics, and we can move on to others. So Fannie Mae comes out and says sellers still thriving as home prices stay high. Sellers rejoice. Roughly 77% of sellers rejoice. Roughly 77% of responders to Fannie Mae's Home Purchase Sentiment Index, a composite index designed to track the housing market and consumer confidence to sell or buy a home, said now is a good time to sell. That's up from 67% from the month prior. So that's a big number. 77% of people are like, yeah, now's a great time to sell. To boot, reported 64% of survey respondents said it's a bad time to buy a home, up from 56% last month. So if you want to talk about the supply and demand thing, it's like you're getting to that point where people are just like, nah, everyone wants to sell, and buyers are like, I don't want to buy anymore because prices are getting too high, or the mortgage payments are getting too high. The percent of respondents who say home prices will go up in the next 12 months increased 1 percentage point to 48%, and the percentage who say home prices will go down also increased to 21%. So yeah, both sides of people are increasing of saying like prices are going to go up or prices are going to go down. Within the past almost 3 months, the aforementioned mortgage rates have only peaked above 3% one time, coming in at 2.98%. So I had to read that the second time. Like, so when they say peaked, it means drop below 2.98% interest rate. In the most recent Mortgage Bankers Association report, the percentage of respondents who believe mortgage rates will go down in the next 12 months remained unchanged at 6%, and the percentage who expect mortgage rates to go up increased from 49% to 57%. 57% of people think mortgage rates are going to be going up, and only 6% say they're going to go down. The share who think mortgage rates will stay the same decreased from 38% to 30%. There's a pretty wide sentiment that's like, hey, always said it, prices can't go on forever. Like they can't continue to rise 10, 20, 40, or Austin 40% year over year, like for long periods of time.
At some point people are going to be like, all right,
we're done. We're done.
Slow down.
And I mean, that's your supply and demand aspect of it, where you have moving populations, you have people moving to certain areas. Eventually the area gets so expensive, they don't want to live there anymore. Look at California. 80s was California's a place to be. Lots of opportunities. 70s where everyone would be, but now prices have gotten so high and things have gotten so expensive that everyone's like, I'm going to look for somewhere else to live.
Yeah.
And that was happening before the whole pandemic, and that kind of just like supercharged it with all the remote work and stuff. So now moving to these lower cost areas, prices are getting insanely high to now where people say is a great time to sell. People are now saying they don't want to buy, and people are saying mortgage rates are going to increase. That's even if they do or don't. It's like it's weighing on the consumer, the people that actually pay the money and put their money down.
So I think that's an excellent point to hit on, is that whether, and this is the reason why we're having these conversations, because whether these things happen or not, that fear that it may happen, that anticipation that it may happen, is what drives the market and sometimes actually makes them happen. Because it's kind of the same, like, the Fed comes out and they're gonna, they all of a sudden they say, oh yeah, we're going to raise interest rates. And then you don't see the stock market really budge all that much. And you're like, why the hell didn't the stock market move? Because they had already priced it in. They anticipated this happening, right? When is it a shock is when they're anticipating interest rates going up and the Fed comes out, they're like, yeah, no, we are not raising interest rates. Now you'll see something in the stock market that's going to be like, oh shit, what happened? This is unexpected.
Those are the things that move the market.
Exactly.
When, something goes the opposite direction. And that's why, like, you read articles about like the Fed notes and Fed minutes and things like that. And it's like, he's very careful with his words because he has to be. Because like the one word difference to where like me and you, I'm like, to me that means the exact same thing. But like, oh no, the markets took that as like the word he chose was so particular. It's like, I'd hate to be the person that has to write those. Like, God,
he scratched his nose.
It's like you got to put a poll. I was like, all right, here's 10 words to describe this. Which one out to different people does it mean different things? And they got to pick in between. They're like, my God, like that would be well,
I mean, I used to trade stocks before I really got into real estate, and one of the things I used to trade on, because it was day trading, and is really on whenever the Fed would come out, it was pretty much betting on what they were going to say. You know what I mean? So one of the things that I made a lot of money on was on the rise of silver, because at the time, this was 2010. So at the time, it was, a shitty economy that we were in and everything. And then the Fed would come out with some crazy ass news, and all of a sudden the market would tank again and silver and gold would shoot up. And it was all based on whatever the hell. If Bernanke at the time, the head of the Fed, would get up and say, you know what? I stubbed my toe coming out of bed. Boom, market tanks. You know what I mean? Nothing to do with the market. And I think they understand that. They manipulate it by what they say. They're very careful with what they say. I don't know how we got into that tangent, but, it's...
you got into that tangent?
Very interesting.
That's very interesting, though. Like, there's a great book I read one time. It's called How Money Became Dangerous. And it goes over the process of, like, how investment banking went from private equity people that owned it, and when it became public stock, like publicly traded companies, like how like people like they bet with money that's not theirs, so it makes it much more dangerous to where like he goes over onto the trading floor, like how people reacted and did different things. Like it's like the whole psychology around that. And it's a very interesting book. If somebody wants to check it out, I mean, we'll add a link to it below. It's a good book.
Well,
but
yeah, and one of the topics that we wanted to make sure that we hit is it's pretty much, the biggest difference with all of this, why we cover all these topics, why we cover everything, is Robert Kiyosaki always talks about, the author of Rich Dad Poor Dad. He talks about the rich don't work for money. And with this whole concept of the rich don't work for money, a lot of people always shrug it off as like, yeah, it's easy for you to say because you're rich and all that. And it talks about the money habits. It talks about the way that you look at a business, the way you look at investing. And this is, I think, an issue that a lot of investors, a lot of people are missing because they're being so transactional. that they're not focused on building something that's going to actually sustain and actually building a business. And it's always been said with this analogy that's it's like planting a seed and then going the next day trying to eat it. You know what I mean? It's like you plant a seed, you got to nurture it, you got to take care of it, you got to let it grow. But the problem is, like, people jump into a business, jump into real estate because they're like, oh, I'm going to make money, I'm going to crush it my first year. Look at this guy, he made 100, 200 grand
Well, I mean, it's
in
not
their
just real
first year.
It's not just real estate too. I mean, it is like the stock market. It's
Everything.
anything to where it's like,
Yeah.
if you just put some money in the stock market and you let it ride for a long period of time, just like real estate, you're going to be far better off than if you're just like, I'm trying to make these base hits to get super rich really quick.
Yeah.
Like that doesn't work that way. Patience is a true virtue when it comes to making money and building wealth.
And the thing that you and I have talked about so many times is that if you don't have the patience, and this is going to go into pretty much like 3 big ideas that we want to share with you on this. And with the first one being is why you shouldn't quit your job to go into becoming a real estate investor, right? This we hear all the time, especially the bigger pocket crowd and everybody. Every time somebody says, even on Facebook, I'm going to quit my job and go full time, everybody's like, oh my God, yay. And I look at them, I'm like, oh my God, you're an idiot. Like, beyond an idiot. You haven't even done anything yet.
Yeah.
Yet you're sacrificing pretty much like that one thing that you have that is consistent for something that you don't even know if you're going to succeed at.
And getting your real estate license does not constitute, well, I got my real estate license. It's like, no. Like, it's having a client base. It's the knowledge around what by getting a real estate license does not you don't know how to do real estate. It's like, it means you can pass a test. You can memorize the information, you can go pass a test. That's all that means. When it comes to getting your license, like that's the first step. You're in the right direction. But just because you got your real estate license doesn't mean you should go quit your job, because you're not going to start making commissions. Like, you're not going to start making 50 grand, 70 grand, 100 grand your first year just because you got your license. Nobody shows up with a list of clients and says, like, I'm ready to list my house. Like, very competitive market where, like, you need to build that business and that reputation and those habits, and you need to understand the knowledge around that. And like, getting your license doesn't teach you that stuff.
Well, and how high is the turnover in real estate, right? I mean, we've seen it since we've been in this. How many people start, they're all gung-ho, right? We're going to crush it. We're going to kill it. Oh, I'm so motivated. I'm so happy. I'm so excited. Look at this. Look at that. I'm going to do this. I'm going to do that. Until they actually start doing what they need to be doing, because they're starting from ground zero. And guess what? From ground zero requires you to do all the shitty work that many people do not like to do. All the cold calling, door knocking, getting cursed at, getting rejected, all the headaches, all the crap that people don't want to deal with. And as soon as they start hitting that, all of a sudden, well, I needed to take a break, and I needed to do this, and I needed to do that, and I can't. And then it's like, all right, yeah, you're not gonna last. You understand? Because this is not gonna get easier. The more you grow in this business, the more stressful it's gonna be. So if you can't embrace the stress, and kind of like I like to say, if you can't embrace the suck, I don't know where I heard it, but I love the phrase of it. It's gonna become, you're not gonna last. No. And then you're saying, oh, let me quit my job, something that's actually providing me the income to sustain my life, to eat, to survive, to go after something that after you start doing it, like, man, I see these people and I was like, man, you're really kind of screwed right now, because you quit a great job, you quit whatever you had to come after something that now you hate doing.
Yeah.
So it's one of those things that's like, you got to be very smart. You got to think about it. You need to think about, like, how are you going to survive? I did a whole episode, and I'm going to link it before. It's called Before You Quit Your Job for Real Estate Investing. And it covers like what you need to look at, because if you're going to do it, do you have reserves to last you, I don't know, a year? You know what I mean? Like, it takes care of not just your living expenses, but your marketing, your real estate business, because it costs money to do.
Well, and it's like you need to understand the financing of real estate too. It's like you need a W-2 income to qualify for loans, like unless you're paying cash for stuff, and then it only goes so far. Or you plan on using commercial loans and stuff like it, which are not your 30-year fixed rate, 3% interest loans. Like, no, they're like 20 year, and you have 5-year ARMs and 4.5 to 5.5% interest rates. So it's like you got a whole different level of competition and financing style that your general public does not understand.
Yeah.
Or doesn't know. So like that W-2 income is a huge thing. I mean, that's definitely something I think we did one about, like probably in that one before you quit your job, to where it's like, there's a lot of things you should do that I wish I would have known before I quit my job in 2015 to move into real estate full time. Looking back, I'm like, damn, I would have just done these things before I quit. That would have been beneficial 5 years down the road. But at the time, I didn't know.
Yeah, and even for myself, I mean, I grew up in real estate. I grew up in construction. I grew up doing this. It wasn't a huge shock doing shitty work for me. Like, I grew up doing shitty work. You know what I mean? I was an immigrant most of my life. So, yeah, we did all the shitty work. So, and it never scared me to do the cold calling, to do all that, all the stress, everything. It never scared me. It never worried me. But there's people that just can't. And also having your job, like you said, you know, besides the W-2 income, that's how you pick up rental properties. I mean, we have friends of ours that are real estate investors that are killing it, even though they have full-time jobs. You know what I mean? They're killing it because their job supplies them with a stable income and credit to pick up as many houses as they want to pick up.
Not little bit of knowledge. Like the knowledge, like once you understand that basic concept, and you get your own finances right, like you can exponentially increase a portfolio, increase your wealth in a very short period of time. Once you just gain that knowledge, like there's still a lot of hard work that has to go into it. But once you understand the basics of it, like you can start buying properties. Then it becomes the management style. Then it becomes the type of housing you buy. Then all the other stuff comes through. But you can get into the level. Everyone's like, I just want to buy that first property. You can get there very quickly if like you understand the basics, you have a good job, you have some savings, and you can find a decent deal with the numbers make right that you can learn with.
Yeah. Well, and then also like the other point that we've covered before is people are going to quit their job, right? And they're going to get into real estate, but don't worry, my expenses are taken care of because I'm going to do the bigger pockets model and house hack, right? And we've talked about this so many times because it's just one of those things that's like, you know, Bigger Pockets needs to stop like pushing this so damn hard. And they need to focus on like, there's a lot more to this, right? Like house hacking in San Antonio is virtually impossible. You know, you cannot find multifamily homes right now you can't even find multifamily homes in a decent area of town that cash flows. Because the investors that own the multifamily homes, they're not letting them go at a reasonable price. They're letting them go at a price that's like market value, and you still got to put repairs over that.
Yeah.
And then when you even finance that, your mortgage is way more than whatever your rent is going to produce. And we went into great detail on house hacking and everything on how you got to protect yourself. But you look at these things, and it's like there's so many unknowns. And the biggest one is your lack of knowledge and experience, right? It takes a lot of experience. That's one thing that I always tell people, even when they come to us that they want to learn real estate and everything. It's like, look, you can buy the most expensive course in the world. You can buy all the books you want on real estate. You can listen to all the podcasts. The one thing that you can never pay for is experience.
Yeah.
Experience, you need to actually experience yourself. You need to go through it. You know, a way to do this is, yes, you can partner with people to learn from their experience and kind of absorb some of their experience. But overall, like, you need to put that time in, because we always see it time and time again. They get into it, and because they have no experience, they don't know what the hell is going on. And then all of a sudden it's like, man, I can't find any deals. Man, I can't find a project, or I just lost 40 grand on this last deal. It's like, well, yes, you don't know what you're doing. But I quit my job. Sorry to hear that.
Yeah.
You understand? Like, I think there's a more cautious way of going about it, to make sure that you're not being so ballsy to just, let me quit my job. I have no savings. I have nothing, but I'm going to do it in this industry that I know absolutely nothing about. Yeah. It's like not the right way to approach it.
Real estate industry has, I mean, I'd love to hear, like, compared to other industries, of like the amount of fluff that is sold in this industry and why that is. Like, there's a lot of what do they sell? They sell the steak, or they sell the sizzle, not the steak,
Mm-hmm.
kind of thing. Where like I think there's a lot of that stuff that goes on in real estate towards like the house hacking. Like, why does Bigger Pockets push it? Because it sells. Because it's sexy. Like, I'm moving to duplex. I mean, it does. Like, just listen to the pitch.
Of course.
Like, it's like you move into one unit, you rent the other units out, and it pays for you, and you live for free. Like, oh yeah, who doesn't want to do that? The problem is like everybody knows that, so those prices reflect that, and that is what buys those things in. Because it's also like when it comes to like institutional investors or investors, like investors go after multifamily, so those prices get bid up very quickly, and especially in the market right now.
Yeah.
To where it's like individual homeowners, your end consumer usually doesn't want to go live in a duplex. They don't want to live in a quadplex. I mean, you just look at the application permits for small one-to-family unit complexes. Like they're basically non-existent. Like it's a perfect example. Like if you look at the last market analysis I did for the 4 metros, you look at the number of unit permits for 2 to 4 unit builds. I mean, there's basically non-existent compared to single family homes and large commercial properties as far as multifamily units. So what housing stock of your 2 to 4 units are available is extremely expensive because nobody's building it and your end consumer doesn't want to buy it.
Yeah.
So it's usually an investor that's buying it. So these prices get bid up very, very quickly.
Yeah. And with that, with house hacking, those investors are picking them up that are putting in that money. They're not house hacking. They need both areas to rent just to cover some of the mortgage, not all of it, because they're probably putting a large amount of money down, but they understand that eventually, appreciation is going to catch up. Everything's going to catch up because of where it's positioned and all that. But if you don't have that kind of revenue and you're trying to house hack something like that, you're going to be in a huge, huge world of hurt when that comes through. So the next big idea is who are the ones that work for money, right? These are the people that are working for the money, and it's your wholesalers, your flippers, your buy and hold investors, your note buyers, your lenders. These are the people that are all working for money. And a lot of people right now are probably thinking, wait, hold on. How's a buy and hold investor working for money? That's the whole point. It's passive income. Not if you're not doing it right.
Yeah.
If you're not buying a rental correctly, you're not doing the analysis correctly, you can buy a house that's it cash flows, but you never factored in the amount of repairs that house actually needs to be worth what even you paid for it. So it's it cash flows right now, but when you need to go ahead and turn around and sell it, and you need to actually do the repairs, you're underwater.
Well,
it doesn't make sense.
And I think that's a perfect point to where buying hold done wrong can be even worse than flipping. So where there's people that I've met or heard about, or how easily it can, towards they have a good job, they have good savings, they discover real estate, and they jump both feet in and buy house very quickly, buying from these big wholesale companies, turn around and renting them, not understanding what a house is and how they act and how they perform and what property management is. They think it's I just buy this house, put a tenant in it, I don't have to do anything anymore, and I hire a property manager, we're done. It's no. How's the foundation? How's the electrical? How's the roof? How's the air conditioner? To where if all those major components are crappy, you're going to get a crappy tenant that wants to live there, because people themselves don't want to deal with that. I had a conversation with one of our tenants recently, and they want to renew again, and their lease isn't up for another 8 months. He's I'm going to tell you right now, we're renewing again. He's
Nice.
Because I enjoy renting from you. You get it. You understand it. It's I don't want to run the risk of moving to a house that I don't know and a landlord I don't know. Yep. Because I know there's a lot of people that a landlord to say okay, you buy a house, you leverage it up, and you're a spreadsheet person. You're tracking your return. All of a sudden the AC goes out, and your AC guy goes out there's man, this unit's 20 years old. You really need a new unit. It's going to be $6-7 to replace that. And you're I don't want to spend it though. Can we Band-Aid it? Can we do something? It's well, I can put a new compressor in it. I mean, that'll run you $900.
And then it breaks every other month, every other week. It keeps breaking because all they're doing is putting Band-Aids on all these issues.
Yeah. And then the same thing with the roof, same thing with the foundation. Or it's oh, the foundation, I'm having plumbing issues. Well, yeah, your toilet keeps backing up. Yeah, you're going to have problems. And I mean, this is a firsthand experience. We fell into this to where, like, luckily the tenant was cool, to where we redid an entire house in the foundation, lifted everything. We knew there was going to be problems. We fixed all the plumbing underneath. Everything in the house of the new stuff held. We just didn't check from the exit of the house to the street. We're like, oh, I mean, shouldn't have to worry about that thing. But the plumbing kept backing up. We're like, what is going on? Finally, we got somebody out there, ran a camera down it, and we realized the whole front line had a huge drop in it to where it was like 3 inches of water sitting in the line, and on a 4-inch pipe, so only 1 inch for air to flow through, to where there was a family of 4 living in the house, and using it, it would continually get clogged up because it wasn't flowing out to the street.
Yeah.
So it was backing up to where we had to spend, luckily we own a house on either side of it. We did all 3 of them at once to bring the cost down, but that could be $4,000, $5,000, $6,000 and your house not being usable for 3, 4, 5 days while they're redoing all that. So you got to put your tenant up to where, like, you got to understand housing performs. To where if you buy a bunch of really cheap, what seems like great deals, cheap housing from these big wholesale outfits and things like that, it's like, they're not good deals. They're not cheap deals because they're going to get very expensive, very long, and over the time. And then you realize, like, you're not bringing in the cash flow to where you're having to dump more of your active income back into these properties. And it's like, and mortgages don't go down over time. That's how you can work for money being a buy to hold investor.
100%, because you got to keep that money coming in and take care of these terrible investments that you just made. And then it's the same wholesalers and flippers. To me, they're kind of in the same realm because we see this time and time again with wholesalers and flippers all the time is that, you know, they get one, make some money. Okay, go get another one. They get that, okay, go get another one. Okay, go get another one. Oh, we got to go get another one. So you look at all this and it's like, yeah, you have to constantly be getting more and more deals, and you're always looking for that. You're kind of like a junkie at that point. Yeah. You're always looking for that next hit, right? Yeah. And that, all you're doing, if you think about it, like, you are literally busting your ass time and time and time again to find that next hit, right? And it's the same thing for lenders and note buyers. It's the same thing. They're always looking for that next hit. So the third big idea here is who is actually building wealth. So as a real estate investor, right, we have your wholesalers, your flippers, your buy and hold. So if all of them are working for money, then who is building wealth? And to us, it's very simple. Those are actually focused on building systems around what they're doing. So if you want to flip houses, or if you want to wholesale, or if you want to buy and hold, you want to lend, you got to put systems in place. Something that makes sure that you're checking and you're making sure that you're not buying bad investments, that you have the right people lined up, that you can do this time and time again to a point where it's like you don't even have to work all that hard for this to start producing on its own, right? Where they say, the rich don't work for money. It's because you are putting the systems in place that are helping you generate the deals, helping you generate everything that you need to generate. So therefore, it's like, okay, yeah, now my system is working for me. Now my system is generating me revenue and generating me what I need from this business and all of this. So it's just, you got to focus on building systems. You got to focus on building a repeatable process. Right? If you can't repeat this process, you're just working for money. If you can't repeat this strategy, you're working for money, right? Because you're doing it once, chances you're going to be able to do it again are going to be very small. It's going to be very different. If you can't repeat it, you're just working for money. And the problem is like we see a lot of times, right? The market changes. Things change. Things become more expensive. There's shifts like we've seen this past year. And because you were doing something that wasn't repeatable, now all of a sudden your whole business model went up in flames. And it's like, so what are you doing now? I don't know. I guess I'll wholesale some houses. What do you know about wholesaling?
Yeah.
Nothing, So, and we've seen this with so many investors, buy and hold investors, fix and flip, lenders. They didn't have repeatable process on how they found their properties, how they managed them, how they vetted them, how they even found the investors they wanted to invest with. So if you're not having a repeatable process, you're just not going anywhere. You're always going to be in the same spot over and over and over. And also, you got to focus on building teams. Right? If you don't put a team around you, if you can't build a team around you to help you with all these areas. I mean, we're talking about it now, how we're hiring people, we're bringing people on. And even for our properties, yeah, we do self-managing because we've seen what it is to hire a property manager, and it doesn't make sense a lot of times. So we prefer to self-manage, but we are going to have to bring in somebody to help manage these properties. So what are we doing? We're building the systems, we're building the process, so that way we can just hire somebody, plug them in, and say, here's our process. When somebody calls with a complaint, here's the process.
Well,
here's the system.
Not just here's the process, like here's the people.
Yeah.
Like even more importantly than the process is the people to do the work in a way that you trust and can do it efficiently and effectively. Because like tenants hate nothing. I mean, just my personal experience, or just think about it for anybody. Like your AC goes out in July and it takes your landlord 2 weeks to replace the air conditioner. How pissed are you going to be by day 2?
Yeah.
And like, how good are you going to take care of that property moving forward if the landlord doesn't give a damn about the property, or you?
Yep.
So it's like, we have our teams, we have our people. Like when something goes wrong, it's like, I can get somebody out there ASAP and do it in an effective way. Because if you don't have those teams, you can always get somebody out there in 24 hours. It's like, is how much you're going to pay to get that person out there in 24 hours. And now if I got a consistent team of people that I got my plumbers, electricians, ACs, like your major components that if something breaks, I got to get somebody out there right away. Otherwise it's going to cause major damage to not only the house, but our relationship with that tenant. To where if I got something backing up in the sewer or something like that, like if I don't get somebody out there in 24 hours, it's really going to, like, people don't like the smell of shit in their house. And I can get somebody out there for emergencies, but they're $200 just to show up, let alone they're going to run a snake down the line. That's another $300. So $500 repair. My guy does it for $100. I can get somebody there in 24 hours. Yeah. So like over time, I need those people, because otherwise if you do everything on the fly, emergencies every single time with new people and build no rapport with like people that can actually do the work, like it'll eat any kind of cash flow return right out of your pocket so fast.
Yep.
It's like you have to have a reliable team.
And why we've gotten burned so many times with contractors is because time and time again, with every project that we do, we're always trying to build our team because we're thinking long term. We're not thinking this project. If we keep thinking on every single house, oh, I just need this project done, I just need this project done, the problem you have is that then that's all you're going to ever have work for. You're not going to be able to build relationship with contractors that you can depend on, with people that you can always count on whenever you need something. Like you're not building that because you're always burning and churning contractors, burning and churning investors, everybody. And it's like, how can you grow that? How can you scale that? How can you even implement this business model or system in any other city if you are so involved in every single step? Yeah. Right. We've heard an investor friend of ours that the way they manage a rehab is they literally plop a chair in front of their project and work from that chair because they need to manage. I'm like, then that's fine. It works for them because of the business model they have, and that works for them. They're not looking for scale or anything like that. But you're always working for money at that point. You understand? Because you got to be at every single one of your rehabs. How many rehabs can you manage at that point? Right? Yeah. How many deals can you do? If you have opportunities in other cities, other states, you can't do that everywhere you go.
And it's a lot of trial and error. Yeah. A lot of trial and error to find these people, these core people that are there. Because, I mean, and that's what I would say, real estate and everything can be so dangerous just jumping both feet in, because like it takes time, resources, money, and failure after failure to find these people, to learn these lessons, to where it's like you're buying one house. Don't go out and buy 5 right off the bat and just 5 deep and then just keep going like ready to go. It's like, it takes a minute to learn these things.
Or if you're going to work with a contractor, don't jump in on 5 projects all at once with the same contractor.
Yeah.
Because then it's like, you don't know what kind of work they do, right? And now you're dependent on them for the next 3-4 projects. And if they suck and you're tied to them and you bought them,
and it's like, and you better know how to replace contractors quickly and efficiently and effectively. It's like, that is the portion of like the quote unquote building teams aspect of it. It's not only just for your business, like your contract team, your field team is probably the most important piece of making sure your investment holds. You can have all the back end office work you want, but if you don't have people to do the work to actually make the asset perform, and people you can trust, like it'll sink you real quick. Because a lot of times we're using big dollars, we're using big leverage to do these things, to where like leverage is great, but it's also extremely dangerous because it can go backwards and unwind extremely fast.
Yeah. Well, and especially in this market, I mean, right now there's so much easy money out there that if you don't understand how to work with that money and everything, you get accustomed to easy money. And then you don't realize, like, when the market changes, when strategies change, and you got used to that easy money and now you can't find it anymore, because usually when the market's changing stuff, that easy money is gone.
Yeah.
Because they're the ones that are scared. They're the ones that, because they're not investing with any intelligence.
Well, I mean,
they're
that's what
just throwing money.
that's what causes crashes.
Exactly.
Is when that liquidity disappears and nobody wants to lend their money because I think prices are going to continue to fall.
Yeah.
Like, that's what makes things fall even faster.
Well, and then the last point here is focus on strategic partnerships, right? And that's something that you and I are big proponents about. We've always done partnerships pretty much on every area of our business. And we were actually, this past week, we were doing our quarterly, rundown of our business, our strategy session, kind of seeing where our business is, where it's going and everything. We were talking with a good friend of ours, Logan. We went to his office space, amazing house. He
cool.
bought this massive little mansion in Government Hill of San Antonio, and gorgeous property. I mean, really cool spot. And we were just talking about like hiring and all this, and we were telling him about how we found a rock star of a acquisitions guy here in San Antonio, and we offered him a partnership. Like, let's open up a company, we'll split it evenly, and let's run this company to acquire, flip, do everything. Like, you're killing it in acquisitions. Acquisitions is a full-time thing. And his biggest holdup is like, well, yeah, but, the percentage split. Like, yeah, it's all even. Yeah, but, on a $10,000 deal, that means, and I'm like, the fuck are you talking about in a $10,000 deal? Like, you're not thinking strategically, you're thinking transactionally. My next deal. And it's like the whole point of partnering with somebody and doing a strategic partnership is for volume, for scale, not for what are we going to do on this one deal, right? It's that, no, instead of you now doing, let's say, one flip, now you can manage maybe 6, 7, 8 flips at the same time. You know what I mean? Instead of doing like one project, you could do multiple projects at once. And he was sharing with us how he did a partnership like that recently, and it's paying out massively for them because now they were able to combine their knowledge, their resources, their capabilities, and they're crushing it. They're doing so much more than they were doing before. And it's like, yes, that is the point of a strategic partnership.
Yeah.
But when you think so small, like flippers and wholesalers do, and everybody's like, no, I got to do it. I got to keep 100% of everything. It's like, do you want 100% of a grape or 50% of a watermelon? You know what I'm saying? It's like, you can have 100%, but it's always going to be of a very small place until you build the teams, until you bring the people, you build the systems. Until you do all those things, you're always going to be working for money.
Yep.
So that's kind of our little rant on why the rich don't work for money and how it is that you can kind of get there yourself is by thinking this way. If you're going to be building a business, if you're going to be getting into real estate, you got to think about how is it that I can do this, and everything that I'm doing, how can I go building a system around this? How can I scale this? How can I branch this off somewhere else? By doing that, it's just going to be, you're actually going to build something that's going to be sustainable and not something that as soon as the market shifts, you're out of business because you have no idea what the hell just happened. So with that being said, I wanted to go ahead and look because I saw there was a lot of comments coming.
There's a question here that I wanted to get to. That Master Jedi,
Yeah.
like he said, absolutely on fire on this live chat. Hashtag crushing. He's dropping some knowledge bombs and some laughable comments there for sure. So your question was like, how does the dynamic relationship work with older resale home neighborhoods when it comes to appreciation? I purchased 1996 rental near downtown Kyle for $255. Kyle has like 4,000 new construction coming online. Does that mean my resale older home appreciation slows down / sucks? It's really a big picture question. Older neighborhood resales with all this new master build construction coming online, appreciation, not cash flow as a rental. So, I mean, the thing that I like about, like, one thing you look at, there's a macro aspect and then there's a micro aspect of it. For like the micro aspect of it, older homes typically tend to appreciate faster than new construction because there's not land around it that they're building. Like, but Kyle is a small community, but you are close to downtown. So it's kind of a two-way thing to where on the macro perspective, like you're on the 35 corridor. Why are there 4,000 new constructions going? Why are all these master plan communities going along? It's because the demand is there for housing along the 35 corridor.
And you're like 20 minutes from Austin.
And you're 20 minutes from Austin, essentially, to where it's like, that's why I said real estate is very local when it comes to certain locations.
Right.
Where like we typically buy in areas that are in developing areas. Now the question I would ask you is, what is the starting prices of those new construction homes? Or if these new construction homes are at $350,000, $400,000, I think you're sitting pretty good, because that means they're not building houses at $255,000 in relation to the job corridor or the downtown area of Kyle, which I don't think there's a whole lot of big industry in downtown Kyle, because it's mainly Kyle because it's relation to Austin and San Antonio and San Marcos and stuff like that.
Yeah, it's almost a suburb of Austin at this point.
Yeah, it's really, they suburbs of San Antonio and Austin, they all run together. So that would be what I would look at, is like, what is the new construction home volume at, and what is the quality of housing? Because they could be selling houses at $250,000, but you look at, you're on a half acre and you actually have land, and these 250 homes are all smashed together, going vertical and nowhere to park. Mm-hmm. So you kind of have to look at that. It's like, what is going to be the ideal price? Like, what is going to be the ideal location for people wanting to buy? So that is what I would look at as far as that goes. But I mean, the good thing is, like, you're on the 35 corridor, your downtown location to Kyle. They're building 4,000 new construction around it because you have so much people moving, or demand for housing in that corridor of housing. So that is what I would look at for like San Antonio is, okay, you said like 390,000. I think you're just fine, because the fact that you have a 1996 home, it's not, so the style of the 96 homes are still pretty comparable to the style they're building now as far as the open concepts, or can very easily modify them to that. So if they're building at 390, you're 255, somebody that wants to buy a house for 300,000 can't buy a brand new house. So they're going to go look at other places to buy. And you being at 255, it's going to bring your prices up so much quicker than something going from 390 to, if so now that, say that house downtown was valued at like 400,000. I was like, yeah, your appreciation might not be there that great, because they can go buy a brand new house not too far away. But the fact that you're at such a lower price, I think your appreciation is going to be sitting very, very well.
Yeah. Yeah, I mean, that's one thing that we always looked at whenever we're buying a house for long term and everything is there a lot of vacant land around it? There's a lot of vacant land. Appreciation can take a huge hit because they start propping up new homes. They're going to be competing with you, and it's really not a competition at that point. But like John says, when the prices are so drastic, it's going to help your appreciation, because it's at least going to bring you up above that $300,000 price point, because the next level is 390, and in a lot of these homes, I mean, 390 is still higher end home, depends the quality, I guess, of who's building there. But, a lot of these areas, especially the homes that we've seen in San Antonio popping up at an affordable price point, they're like these freaking matchbox looking homes, no
1,000
carport,
square feet, no garage, no carport on 0.07 acres. Like, you are just
your dog wants
together.
to go to the yard to take a piss. It's just like steps out the door and lifts his leg, because any more than that, there's no yard. So it's like, it's one of those things that you got to look at what your competition actually looks like. And there's a lot of people that in these new developments, you have no trees, you have nothing, it's very bare, where in these older developments you have more mature trees, you have it looks nicer. So there's a lot of people that like those amenities as well. So you got to keep an eye on that. Like, does this neighborhood have like an appeal, a charm to it, something that will make people want to be here? I mean, from being downtown Kyle to being outside of downtown Kyle, I don't think it makes a difference. What's that, like 2-3 streets? I mean, like,
football throwaway.
Yeah, you're not really at a massive like San Antonio. If you're downtown San Antonio versus on the outskirts, now you are talking about maybe a 40-minute drive with traffic and everything.
Where I would be worried is saying like, hey, I bought a new house built in 2017 right across the street or less than a half mile away from where they're building all these brand new houses. That's when I would be worried, because it's like prices in 2017 were still fairly high. You probably would have been paying like $330, $340 for a new house, where it's $390. That's where you get into trouble buying what John talked about. Like, there's a lot of vacant land. It's like we bought, or not we, like my mom got a rental property on the outskirts of San Antonio and out by Converse.
Yeah.
But picked it up for 120,000. It's like they're building new homes all over out there, but their starting prices are in the 200s and higher. To where it's like, and they're smaller houses and they're more condensed together. To where like ours backs one of the major roads. There's a fire station across the street from it. It's not gonna, but it still has appreciated.
What year is that house?
2005.
Exactly. So you weren't also buying like a ridiculously older home.
Yeah.
You bought a 2005 home. So the aesthetics, the appeal, everything is still kind of there to these new neighborhoods. So you kind of have a new home severely underpriced to what the next homes are selling for.
Yep.
So yeah, so that's something. I hope that helps Master Jedi. He says that he loves mature landscaping. It turns him on. So apparently he likes mature wood. That being said, I wanted to touch on this topic before we start wrapping up, and it's oil prices. I mean, we're seeing oil prices just keep going up and up and up. Last I saw, I think oil is trading at like $73 a barrel. I mean, that's just nuts. I mean, we haven't seen 73 like since like what, 2013 ish.
I thought it was even higher. I thought it got to like 120s and like, oh, that was more like 2008, 9, 10 that got that high.
In 2008 and all that, it went beyond
74.52 is what.
So it's going up again. Wow. So all of this affects literally everything you do in your life versus, as far as like building houses, buying houses, renting, buying food, filling up your gas tank, everything. I mean, everybody just looks at oil prices at the pump, and it's just much more than that, right? So the article goes to say oil jumped to its highest level in 6 years after talks between OPEC and its oil-producing allies, OPEC Plus. So they also have their streaming service, were postponed indefinitely, with the group failing to reach an agreement on production policy for August and beyond. Discussions began last week between OPEC and its allies as the Energy Alliance sought to establish output policy for the remainder of the year. The group on Friday voted on a proposal that would have returned 400,000 barrels per day to the market each month from August through December, resulting in an additional 2 million barrels per day by the end of the year. Members also proposed extending the output cuts through the end of 2022. For us, it was a good deal, UAE Minister of Energy and Infrastructure said, and he added that the country would support short-term increase in supply, but wants better terms if the policy is to be extended through 2022. My goodness. With no increase in production, the forthcoming growth in demand should see global energy markets tighten up at an even faster pace than anticipated. This impasse will lead to a temporary and significantly larger than anticipated deficit, which should fuel even higher prices for the time being. The summer breakout in oil prices is set to gather steam at a fast clip. So they came to an impasse. They cut down, I believe I was reading before on a different article, like they had cut down oil supplies by like 10 million barrels when 2020 happened because nobody was going anywhere, right? Nobody was driving. So they cut that down, and slowly they've been adding more barrels every day to the market. And now when OPEC Plus came out and they said they wanted the 400,000 per month till the end of the year, and then also increase the supplies through 2022, OPEC said, no, we kind of like these high prices.
I know, that's what it's like, what is their issue of like getting more oil to the market? But it's like, yeah, they want prices to go up. 'Cause I mean, I know like oil companies obviously got hit really hard last year when like everything started like crashing and falling through the floor, to where they're trying to make some of that money back up. But now, especially since the U.S. is cutting its oil production down, where it's like, well, now we got the biggest consuming economy in the world cutting its oil. It's like, well, we're going to boost these prices and we're going to start getting some of that money because they're no longer oil independent. They need our oil.
Yeah.
So
Yeah. So my question to you, I guess, in this whole topic, so oil again, it affects everything, right? Because what are we looking at? If oil prices keep going up, gas prices are going to go up. It's going to affect transportation, right? We've already had a huge hit because of transportation, the lack of truck drivers, the lack of laborers, and everything that's hurt supply chains tremendously. And we've seen it in the housing market, not just in lumber, but in finished goods, right? Like toilets, cabinets, I mean, light fixtures, everything. Where we're just there isn't the supply because they got to be delivering them. So it's already been hurting that industry, and then they've had to increase the pay for truck drivers. And in a lot of areas, they've gone from as low as 40 grand to as high as 140 now that a truck driver makes a year. Insane
Yeah.
growth, right? So all those expenses, everything, we go back to the inflation talk. This affects the end consumer, right? Because all of that gets passed down. So now you add to that these rising oil prices, and they're predicting oil to cross $100 a barrel. It's going to further hurt transportation. It's going to further hurt, all the transportation of ingredients, storage stuff for grocery stores, for everything. So, I mean, what are you seeing and what are you thinking are some areas that we need to watch out for with this kind of news?
I mean, it is going to be something because it's like the big industries. Like, yes, we're moving very quickly towards renewable energies and things like that for the end consumer as far as like cars and stuff like that. But like when you're talking a semi having to pull thousands and thousands and thousands of pounds of lumber in weight to move this stuff around to get these materials here, talking building materials, concrete, some very heavy stuff. I know Tesla's coming out with like their cement, they're not cement truck, they're electric vehicle, but it's also these trucks don't run. I get a battery. It's like it needs to be charged. Like these trucks run thousands of miles at a time, and with dual drivers and things like that, to where an electric vehicle, like you're talking having to fleet these things up drastically. Your battery powers the capacity. You got to generate that power. Like where's all that power come from to move these things? Where like high oil prices are going to affect your consumer goods as far as like moving, just for the fact of just trying to move this stuff around the country, building materials. I mean, trains, like I don't see it. I haven't heard any talks of like a bunch of electric trains. I mean, I know you got your bullet trains, passenger trains, but like these major trains pulling hundreds and thousands of cars and lumber and things around. Like I don't see very many of them going electric at a very rapid rate, where it's like there's a lot of technology that needs to come out, and that battery power, not only battery power, but the power generation quickly charge those things, because if they're just sitting still, that means they're not moving product. Not moving product means they're not making money. Where it's like, if it's got to sit there and charge for 3 days, or it can move one load across the country, well, it's equivalent fossil fuel just made it across the country 3 times.
Yep.
So,
yeah, I mean, it's going to be one of those things that, you're looking. I'm more curious, like, is this going to further push? Because the administration that we have and everything, they're very big on going green, on the alternative energy and everything. So do you think this kind of push on OPEC and everything going to make the administration and all these companies kind of like, hey, we need to get our shit together and really push alternative energy, which in turn I think is a very bad play for the oil producing companies, right? Because you have all these oil producing companies playing these kind of games where it's like, if you keep forcing the market is going to find an alternative. Eventually they will find an alternative, and then you're kind of screwed, because what are you going to do at that point? So I think it's something that I see you guys playing the games and everything because you can at the moment, but don't underestimate innovation and, desperation with people that.
Well, I mean, you look at OPEC. I'd be curious to see like what percentage of the world they provide as far as like oil goes, because like there's not much over there as far as industry goes in the Middle East. It's oil. That's what they got. They got lots and lots of oil, and that's like their major economic driver. Where if it's like, well, they get a lot of sun, you got solar generation, you got power generation, but like, yeah, but their entire infrastructure is set up to move oil, and to where they really don't have a lot of anything else, because they're taking oil money to replace the oil. Like those people don't want to change. At all. Or like the U.S. is very diverse in our asset pool of like how we can produce energy. But yeah, you keep messing with those things. It's like, well, try to eliminate us, we're going to continue to increase oil prices. So it's going to be a very painful transition when it comes to that.
And then
because
you're also looking at, like, I'm looking at this summer, travel, right? It's going to affect like people traveling. Your gas prices are going up. Everything else is going up. And it gets to a point where maybe a lot of families that were thinking about traveling are going to be, I don't know. It's going to cost us even more money now. Cause I mean, we went from like what, $42 a barrel to like 74 now just this year alone. So I mean, that's a massive bump right there. You're talking about nearly 100% increase that it factors in. Then you have air travel and all these other things. That's like it's all, we go back to the same thing. Everything is roped in together.
Yeah.
That something like this, it's not just, oh, I pump my gas and oh my God, this sucks. No, it's everything now, and we get our Home Depot rewards for gas. And I was like, hey, what the hell happened with the Home Depot rewards? You're like, well, when these gas prices.
Yeah, it's like, have you seen the price of gas?
Yeah.
It's like when gas is free, you don't really look at the price, but also it's like, oh yeah, you chew through $6 in rewards really quick when it's $3 a gallon.
Yeah, exactly. I was like,
well, last summer
shit.
It's like we had $8 at one point. It's like, hey, we didn't pay for gas for like 4 months.
Yeah, it was quite some time that
we could have got down to like damn near like, what was it, like the lowest? I got like $1.20s. But it's also like we have seen these prices before when it comes to gas. Like 2008, 9, and 10, they were higher than they are now.
Yeah,
so it's like, but then everything kind of came back down. And so they come in, like Brian's point, but everything comes in cycles.
Oh, 100%. My point is just like, it's too many cycles hitting at once is what I'm going at. Is that you're looking at the same thing. You're looking at, the pandemic, right? The pandemic caused all this strain and everything. It's caused unemployment, crazy unemployment. It's caused even employment to be an issue where there's a lot of people that are quitting more of their jobs. They're not wanting to go back. They want, higher wages, whatever it is. But you add that, then you add the inflation that's coming in with the housing market, with rents, with food, with everything. Now you add higher gas prices. And if they happen to raise interest rates, I mean, there's just too many things that, yes, they're cyclical, but these were forced into the market. That my thing is like all of this perfect storm, when does this cycle kind of like peter out, if it does? Or more my guess is that the pendulum's shot in one direction, and I believe that it's going to overshoot in another direction. What does that look like? I don't know. I just don't think that it's going to go crazy as it is, and then it's just going to nicely stable off. Like, I think we're going to get a lot more whipsaw in the market, in a lot of the things that we do as investors, as business owners, as just regular consumers in the market. So these are things that I believe you need to be cautious about. You need to really keep an eye on.
Well, I mean, Brian, thank you for looking that up. But he said like OPEC produces about 40% of the world's oil and has about 79% of the world's known reserves. Like they're going to fight like hell to keep that. And because that is where all of their money comes from. 90%, 79% of the world reserves and 40% of the entire world depends on them.
Yeah.
It's like, yeah, they're going to do a lot. And it's like, we're very energy dependent world.
Yeah.
So it's like any production.
Or we should go back to coal. I heard coal was very efficient and cheap.
Yeah.
It killed the environment, but we got around.
I mean, hey, let's make in Texas a nice, cool, rainy summer for you to give enough rain like this constantly. Trees are going to grow.
Oh, man, that's terrible.
I don't know if you're going to get mountains out of it, but
yeah. So that's something that seriously, guys, keep an eye on. Keep an eye on what's going on with oil prices and everything, because it's not just your gas tank that this is going to affect. It affects every area of your life.
Well, I mean, Master Jedi's put a question here. It's like, why the hell is gas so much more expensive in California? It makes no damn sense. Like, it's straight taxes.
Yeah.
Straight taxes.
Yeah.
It's where you look at, like, just Google the state gas tax per state, and you'll see California has some of the highest, and Texas actually has some of the lowest. That's why we usually have our gas prices are $2.70 here, and it's $4.25, $4.50 in California, where they probably have over $1. And not only do the states implement gas taxes, counties implement gas taxes, and the cities implement gas taxes. To where my girlfriend and her family's from Southern San Diego or Southern California, and there was a big dispute there to where the municipality came out, or the state came out in one shot, put a like 25 cent per gallon gas tax, and boom, overnight gas shot up 25 cents. And the state took all of it, and they did it without voter approval either. They just did it. And then they realized like a few years later, it came back to where they had to get voter approval. But then the way they worded the ballot, by thinking you were voting against it, if you didn't read the specific words, you're actually voting for it, to where it was just a huge thing, to where like, if you just look at the taxes of gas, like gas really probably doesn't change too much between state and state of just the actual gas itself. But now when you talk at the taxes on top of it, is where you get these massive differences between states. I mean, just in when I grew up in college, like Missouri had 10 cents less per gallon in gas. And we were right on the border. There was a gas station. If you went 4 miles and it was state line, boom, gas station. Run down gas station, but always packed.
Always packed.
Because people were always driving that extra bit to go get gas.
In New York is the same thing. We had Jersey had always much cheaper gas than New York did. So when we used to do construction and everything, we used to do a lot of houses in Jersey because we were in that little tri-state area, so it was easy to get to. And yeah, I mean, I remember my dad with his construction trucks and everything. He would just wait, like, all right, we're kind of running low. Well, we have a house coming up in Jersey, so hold off. We're gonna fill up once we get into Jersey, because it was a massive difference. You know what I mean? In prices, and it's just those are the things you got to pay attention to, and that's why when you look at. We talked about this last week of why so many people in companies and everything they're coming to Texas, they're leaving California, and all, because all of those things add up. What they're taxing you, how they're hurting your business.
Master Jedi's point is that even with the tax, that ratio is not right. It's like, well, it's still not right. But then it all compounds on each other. What's it cost to run a business in California? Texas costs you nothing to keep an LLC open. California, $800 just to keep an LLC, even if you don't make $1. So then the trucking industry, the taxes on trucking businesses, the tax on oil production in that state. So like you add all that in there towards like, that's where you get those ratios, is like, it is taxes, not just on the state gas tax per gallon, but the tax on the businesses, the tax on the incomes, the taxes on the trucks, the taxes on petroleum products, the taxes on the cost of moving that oil around. It's like, that's where everything comes from. Since I moved to California, in my mind, gas are now a nit now. I'm a hit now. It's basically free in Texas. Anytime I have family that visits from Southern California, they're like, man, everything's so cheap around here. It's like, even I go out there and I'm like, God, I want to go home. Everything's so expensive.
I have family that when they come down, even they smoke cigarettes for whatever reason, and people still smoke cigarettes. And they're like, man, even cigarettes are so much cheaper down here. And it's like, yeah, this is Texas, man. Like they're not focused on killing you on everything you make. But that being said, I wanted to wrap up with this last article because I thought it was. I think it was an interesting point to hit as far as we all go in our lives and business. But you have a hacker gang was behind an international crime spree that played out over the 4th of July weekend. It says it locked more than 1 million individual devices and is demanding $70 million in Bitcoin to set them all free in one swoop. The the Russian connected Rehab, so R-Evil, is best known for previously having hacked JBS, one of the world's largest meat suppliers, briefly halting its operations across much of North America. But this attack's potential scope is unprecedented, some cybersecurity experts say. So Rehab began its spree Friday by compromising Kaseya, a software company that helps companies manage basic software updates, because many of the Kaseya's customers are companies that manage internet services for other businesses. The number of victims grew quickly. Instead of locking an individual organization, as ransomware gangs usually do, Rehab locked each victim computer as a standalone target and initially asked for $45,000 to unlock each one. The Swedish grocery chain Co-op is the largest known victim. It closed most of its about 800 stores all day Saturday. 800 stores. Its registers were controlled online by Visma, a Kaseya customer, and locked up and rendered unusable. Rehab's claim that it has compromised more than 1 million devices is impossible to prove because few victims are speaking publicly and no government or company has a database of everyone who was hit. So here's my thing. As I'm reading this, we kind of been dealing with this issue on and off this year of hackers and shit that's happened to our systems and our stuff. It's scary, right? It's scary to think because you're thinking like a lot of us, maybe you use Google Drive or like us that we use a server company for our office server and all this. That you're like, okay, yeah, we're good, we're protected. We hire this big company. But if that big company has the slightest little weakness, they penetrate the company, and in return, they penetrate everybody that company touches. And how do they get to 1 million devices or 1 million people? Is because those devices are connected to other people that can connected to other people. And they're like, these viruses, they're made in a way that it goes to the next endpoint of computer of technology. And lately, we've been having an issue with one of our printers, and our IT guy, he looked at it and everything. He's like, seems like somebody's trying to hack you guys through your printer. I was like, the fuck? What does that even look like? Like, I didn't even know you could hack a printer like that, and it's just...
It's got power and connected to the internet. It can be hacked.
And it's just one of those scary things, right? That you think about as a business owner, as anything, that you think you're protected, right? Your business is protected and everything because you hired Google or you hired this. And it's like, no, they can still pierce that and still get all your stuff, or still lock down like they did to us at the a couple months back, that they encrypted all of our files. You know what I mean? And they wanted the same thing. They wanted to get paid in Bitcoin and all this stuff, and they encrypted everything, and it hacked our server, which in turn connected to our G drive, which connected to all these things, and it hacked everything, right? And it's like, holy crap.
Yeah.
Like, what do you do?
I mean, that's just like, say you have to have fail safe on top of fail safe on top of fail safe, to where it's like, yeah, it's a very rudimentary thing that we do, but it's like, it can't be hacked because it's not hooked to the internet constantly.
Mm-hmm.
So like our now backup system, it's just like, that's just how we have to do it. It's like, because it's like, you really have to do that every week. Yeah. Because if this shit happens, we only lose a week of our business.
Yeah. And that's it. And we don't fall prey to this. But even then, like, now they coming in through, let's say they can hack our printer and come in through into our network through the printer. Now they can access the rest of our network. So now we need to make safeguards to even our own computers, because if they hack into our network, they can access our computers, which has all the passwords, bank account info, everything. So the next thing is like, I've started doing for quite some time, and we all do it, and I recommend you guys do it, is the 2-step verification. So your emails, your bank accounts, anything that has 2-step verification, you should definitely do it. Because even if somebody was to hack our stuff, we get that 2-step notification instantly on our phone of like, you got to approve it through a text message or through an app on your phone or through something. So they may be able to hack one layer, but now they got to hack the other layer.
I know I know it's annoying. It's an inconvenience. People don't want to do it, but it is a huge thing. Like, I hate it every time I need it, because our Adobe, like, you've used it, and I'm like, I need to use it. I log in, it says, oh, you need to sign in. I sign in, and it's under your phone. It's like, ugh. I can't go to Gilda John right now, so I can't open PDFs on my computer because like you were busy. You're doing something.
It seems like
it's not unlocking.
You need to learn how to hack then. But so Master Jedi said that John swore again. What is it with you? You have a potty mouth today? Why you keep swearing? Stop swearing.
God,
my God. I'm over here. I'm a good person, and I don't never curse, so it hurts my ears to apparently hear you curse. That being said, yeah, it's something that I think is very scary, because they're coming in literally through anything and everything. And this really sucks for us, because the more programs, the more things that we have, services and everything, this means that we need to we need to be recycling through our passwords consistently.
Oh, it's so annoying.
What I mean? And it's just one of those things that's like,
using the same password for everything.
You can't.
Like, you can't. It's like, it is working itself like to almost once a year.
Yeah.
You got to go on there and like, damn it. Like, I got to go through and cycle through all my passwords. I got to change everything. Mm-hmm. Like, and then you got to remember this one password. But if you forget that one password for like a LastPass or a password bank, it's like, shit, I don't remember what the hell that password is. And like, I because LastPass recently did that where it logged out of everything.
Yeah.
Or you had to log back into stuff. And I was like, logging to LastPass. I was like, oh God, it's been so long since I logged into that. Like, what is it? And like, I went to do like forgot passwords. Like, they don't even keep it. Like we don't store your passwords or anything like that. So like you have to reset it, and it's a process to reset a master password. Like just like your Apple ID, you forget your Apple ID. Like, oh man, is that a nightmare to try to replace?
As it should be, and that's something that you also got to be careful. Is I know a lot of people that are watching that they use Apple Notes, their Notes app, to house all of their passwords.
Yeah.
Like, guys, your phone is literally the most vulnerable device out there, because what does everybody do as soon as they go somewhere? They connect to the Wi-Fi.
Yeah.
To any free Wi-Fi. Starbucks, Home Depot, HEB, they always connect to the free Wi-Fi. Those free Wi-Fis have no security. Any half-decent hacker can go on there, and every device that's connected, they can see every single device.
Yeah.
And they can get into every single device. And if you're one of those people that likes to keep all of your passwords in your Notes app, it's not, innovative things. Everybody knows that.
Yeah.
That's all they got to do is they open your Notes app. They got everything. And you are keeping you're not just keeping just your bank password, but what the freaking fail-safe passwords are for, like what's your favorite food and what's your favorite this and all these other things. And it's like you just gave them everything. Like you give them access to your whole thing. Yeah. So I don't know. I'd be curious for anybody that's listening, if you have feedback, like what are ways that you can protect that? Because VPNs, even then, like they say, no, VPNs aren't all. They can't protect you against all of this. Their hackers bypass VPNs all the time. Antiviruses, they don't do shit anymore. It's like, how do you protect yourself? Especially when these massive corporations that are focused on like cybersecurity are getting hacked.
Yep. And
their clients are getting hacked. It's like,
well, then it's even then, like usually they want to go after big corporations and big things, but nowadays it's like they go after small.
No, but they go after the big corporations and they hit the small people in relate because it goes right through to everybody else.
As printer. Yeah. Like they didn't find that through a massive corporation. It's like what they're like what Jeremy was or our IT guy was talking about. He's like using like the subsurface of Reddit, figuring out that like I think those because our printer was spitting off these weird little codes and stuff. He's like, I think somebody's trying to hack in through your printer port. And he's like, well, you have a HP 8600 printer, and he's like, it's an older printer, and its firmware is probably outdated, and it doesn't have an automatic feature to update those things. He's like, that's probably what needs to happen. Is like, so they just know some hacker out there knows that these 8600 HP printers are older, connected to the internet. One of the first generation printers to really do that.
Gave everybody the model. Nice.
Yeah, well, it's unplugged and not connected to the internet anymore.
My goodness.
And it'll be fixed.
That's how they do it. I figured it out, guys.
But it's like, so they're obviously scouring networks looking for these printers. Right. It's like, and we weren't the one that bought that printer. We found it at a house somebody left behind. So there's no receipt that we were the ones that bought the thing.
It's not targeted. Yeah,
they're searching networks, finding these things, and they just try to ping through that. But luckily, the rest of our network is tight enough to where like they can't get through. He's like, but they are trying. Yeah. So we do need to fix that. Because like it takes one person to know they can get through the printer port to realize a new ways around to get some software and they can get through something.
Well, and then even then, like you say, okay, they got through and they didn't cause any damage, but you don't know if they're still in there. You don't know if they put like some monitoring system or something that they wait all the data, all the stuff that you use, and they're just copying all the stuff as you use it because they're just running in the background. So it's like there's a million things that can go wrong. And even if it doesn't go to that extreme and they do what they did to us, right? That they just encrypted all of our files. What level of a pain in the ass was that for us for quite some freaking time to be able to fix that whole mess? You understand that it's like, okay, we were able to recover everything, but it took some work to be able to recover everything. We're still
finding random, not problems anymore, but you're going through an old file, then you see a text file that says read me. You're like, another one of these damn, because they littered it across our entire, I just found some more the other day. And I was like, you bastards.
Oh, yeah. So, well, with that said, guys, we're a little over our 2-hour mark. I hope you guys really enjoyed today's episode and everything that we shared. We definitely enjoyed the conversation in the chat. So make sure you keep coming back every Friday morning, 8 a.m. And text us to be alerted of all this. Text CWTJ, so Coffee with the Johns, to 210-794-9898. And it matters a lot that you just give us that little thumbs up. And if you like the content we put out, subscribe because you get notified every time we drop a video. And we're dropping videos every single day. So our goal here is to help educate and help you guys as much as possible, and just kind of help the community. You help us help you, help us help you. So with that being said, guys, thank you all for watching, and we'll catch you next week. Goodbye.